what is the right strategy that you might want to implement when you actually need your corpus, you actually need the money that you've accumulated for so many years. It has to be different for every investor because it's your financial portfolio and it is a customized way that you have planned your portfolio. So it is not one medicine for everyone or one strategy for everyone, but on the discussion today, we'll try and decode different strategies that senior citizens specifically might want to adopt from here on. I have with me to talk more on this Shweta Rajani, Head Mutual Fund, Anand Rathi Wealth. So, Shweta, good evening and welcome to the show. Lots to discuss on SWP, but then let's start with a very basic question, very important question in a very simple way. If you might just want to explain us what is a systematic withdrawal plan.
Sure. Good evening, Kavita. Like you said, systematic withdrawal plan is, in very simple terms, a plan which allows you to have a specific amount in your bank account at a specified interval. So, for example, let's say your monthly living expenses is 20,000, and you want on first of every month 20,000 should be credited from my investments or mutual funds into my bank account. By filling in a systematic withdrawal plan form, every month on first 20,000 will get credited to your account. It will be redeemed from the scheme, credited into your fund. So it gives you that regular income on a particular date that you would need for your various needs, and it's very efficient, effective, even from a tax standpoint.
All right. So even now, as a concept, Shweta, we know that SWP can be taken up or applied by any kind of investor. But my thrust on the show today is to explain senior citizen, because for them, a lot of them actually they depend on their regular income after retirement on an investment portfolio. If people are getting it via rental income or the interest that they're earning from fixed deposit, that's a separate thing. But then when we talk about investments like having an equity-based or equity-oriented financial portfolio, how can SWP help them? There is a particular time and a stage when you need to start planning this, and when we talk about retirement, this has to be the first goal because you need to invest for a very long time to reach the corpus that you might want to achieve. We also have to know that after retirement, normally we see people don't have any other income, though that trend is changing now. People are also looking at other various aspects of making money or having a regular income. But then for someone who's dependent on a financial portfolio, it's important for them to know when to activate SWP, and before that reach a certain corpus from which they might want to activate this particular feature. So talking about senior citizen, how helpful will SWP be?
Absolutely, Kavita. See, your retirement planning should start as early as possible because, targeted is a retirement age would be somewhere around 55 to 60 years. So, 20, 25 years before that, if you start planning, that's the best thing. Now, when should you, actually trigger for an SWP? Uh, and what should actually be your asset mix? That becomes very important. You may be having a completely equity portfolio, let's say, till you reach that age of retirement. But I would say just 2 years before you are going to be, entering into your retirement phase is the time for you to relook at your asset allocation. If you're 100% equity, post-retirement, that cannot continue. Post-retirement, you may want to have somewhere around, let's say, an ideal 60-40 equity debt allocation, say plus minus 5-10%, depending on how an individual's risk appetite is. Second important point, how much should be your systematic withdrawal? I'll just give certain examples with numbers. Let's assume that you have a portfolio value of 1 crore. Ideally, your withdrawal rate should not go beyond 4-5% of that. Because let's say your portfolio is growing at around 10%, you're withdrawing 5% of that, it'll help the money stay for a longer time period. So coming back, if you have a 1 crore corpus, then ideally your withdrawal for a particular year should not go beyond 4.5 lakhs, which means you can have a monthly withdrawal of, let's say, 30 to 35,000 every month. In this way, as your expenses go on increasing because of an inflation impact, you will still be able to sustain and post inflation manage your living expenses easily for the next 40 50 years of your life. So knowing what your withdrawal rate is and not going beyond that 4 5% becomes very important. Third, I would say that have a 6 month worth of expense as your emergency fund in some liquid instrument, so that your disciplined systematic withdrawal is not getting impacted because of a sudden medical emergency that may come in, or some other unexpected cost. Fourth, I would say is the next 3 years worth of expenses that you may have. Just coming back to this example, if 4 lakhs is your monthly is your annual expense, then roughly 12 lakhs is your expense going to be for the next 3 years. This amount should not be in equity. It should be parked in, let's say, in debt or debt oriented instrument like an arbitrage fund. And that will allow you to have a peaceful sleep, because you're not worried about where my next month's expenses would come in from and would that be impacted because of an equity market volatility. And the rest of the money which is there in equity, you're allowing it a decent time frame to grow without being bothered about the market volatility. So these are quick 4 5 checkpoints, I would say, especially for a senior citizen, because you're going to be relying on this corpus that you've saved for your retirement phase. You must keep in your mind.
Shweta, just calling out your strategies once again, having an initial withdrawal rate of almost 4% of your portfolio per year, rebalance your portfolio periodically, cash reserve for almost 6 months should be maintained. You need to have a healthy, a good amount of health insurance coverage on you, and investment should be diversified across AMCs and even asset class. Now, I want to understand, there is a part of your portfolio where you are withdrawing money, but there has to be a part of your portfolio is also growing money for you, right? All said and done, you have created this corpus, you have accumulated this corpus over a period of time. So, how much growth then can you expect from your investment portfolio, and how much part of that investment should be in withdrawing, and how much part of it should be in growth?
Sure. So, let's say you're following a 60/40 asset mix, which like I said, depending on the risk appetite, it can move 5% here or there. But with this combination, let's say 60% of your portfolio is growth oriented, because that's getting invested into equity. That has the potential to give you around 13 14% return if stayed invested for 3 5 years. And debt will give you around a 7% of return. So cumulatively, with this combination of 60/40, your portfolio is growing at the rate of roughly 10% per annum. From this, your withdrawal, like I said, is going to be at the rate of 4 to 5%. Okay. So while your portfolio in a particular year, let's say this 1 crore has grown to generate 10 lakhs of return for you, you've withdrawn 5 lakhs of it. Next year, you're starting off with 1 crore 5 lakhs, which is where, that combination of a 60/40 asset mix and not exceeding your withdrawal rate beyond a max 5% will help you compound, be in the retirement phase, get your required living expenses through the SWP route, and not compromise on the growth potential of the portfolio. Can help you actually sustain it for the next maybe 40 45 years of your retirement phase.
Viewers also connected online, and I have Mr. Ajit connected. But then before we take up his question live on the show, just one quick question on SWP and the tax implication. Now, since you are withdrawing that money, and it's coming out from a particular investment, and you are taxed only when you start taking out money or withdrawing money from a particular investment. So, how does SWP become an effective or an efficient way of using your investment with less tax implications?
Yes. So, see, when you're doing systematic withdrawal, like I said, this has to be in instruments from debt or debt like instruments. So, if you go in for a debt mutual fund, it'll be taxed at the marginal rate, which could go up to 30%. But if this is in arbitrage funds, because they are, they work debt like, but because it's an equity taxation, you'll have a 15% short term capital gains for any withdrawal for less than 1 year. So it's better to do a SWP from, let's say, an equity arbitrage fund than a debt fund. Second, from a tax standpoint, when you are withdrawing, there is a component of principal as well as gain. You're not only redeeming from your profits. Okay, so in the initial phase, a larger portion of the units that you withdraw would be the principal component and less will be the gain. So that will help you actually, pay lesser taxes on the portfolio rather than, let's say, keeping it in a fixed deposit and that interest income coming to you, which is fully going to be taxed. The entire money that comes to you would be taxed. Here, in the initial phase, a larger portion is your principal. So therefore, it becomes more tax efficient than having a fixed deposit. SWP will work better for you.
All right. There are a lot of other aspects of SWP that we will bring, we'll include as a part of our discussion going ahead. But then let's quickly also connect our viewer. I have Mr. Ajit from Hyderabad connected on the phone line who wants to ask his question. Ajit, hi, good evening, and thank you so much for sending us your question. You have an SIP going on of 48K from almost a year. Target is 1 CR in 8 years, and you have Quant Small Cap, HDFC Defence Fund, Axis Small Cap, Mid Asset Large and Mid Cap, Parag Parikh Flexi Cap, PGIM India Mid Cap, and that's the fund mix for 8 years that you've decided for yourself. Is that right?
Yeah, that's correct. Thanks.
Okay. All right. So let's just quickly get a portfolio checkup done from Shweta. Shweta?
Yes. Good evening, Ajit. Coming to your goal, firstly, if you continue with the same SIP amount, you will get to somewhere around, a point 80 lakhs odd figure. So if you want to reach a goal of 1 CR, you have two options: either extend your investment horizon to around 12 years, or you can do a 10% of step up in your SIP every year. So that will help you attain your goal. Coming to the schemes, a lot of your schemes are actually good. But what I observed was there's almost a 50-55% of mid and small cap exposure to your portfolio. I would say 45% exposure to mid small is good. Keeping that in mind, I would suggest you to exit from the Axis Small Cap Fund. You can instead go in for an ICICI approved dividend yield fund that's large cap oriented. Second, exit from a PGIM mid cap. You can go in for a Kotak emerging in the mid cap space that's more consistent as a fund. Third, I'd say avoid a defense fund because their cyclicality or timing your exit would become very important. So rather than having an HDFC defense, you can exit that and be in a Canara Robeco multi-cap fund. That's my recommendation to you on the portfolio.
Mr. Ajit, is there anything else that you would want to ask Shweta?
Yeah, that's helpful a lot.
Okay.
Just want to add, I'm currently standing at 15 lakhs. So that 8 years would be sufficient. I'm currently standing at 15 lakhs. To make it 1 CR.
Shweta? Yeah.
Yes.
Are you in a position to extend your investment amount? Add on more?
Yeah, I can.
Okay. Sure. So step up is not a problem over here, Shweta.
No, then absolutely. If you're looking at a step up, like I said, you can continue with that 8-year target in your mind. Even with a 10% step up, you will be able to achieve that 1 CR goal of yours. And even if I think I heard you saying you can do a lump sum investment. If you can do that lump sum investment of around, let's say 10 lakhs odd, even that will be able to bridge that gap over the next 8 years to get to your 1 CR goal.
All right, Ajit, all the best. And let's take another question from Mr. Srinivas Chituri, and this is via email. Shweta, he says that he's a retired person and wants to invest 10 lakhs in a mutual fund and opt SWP. And he wants to draw almost 10,000 per month from this investment. And he wants to know the fund mix that you will suggest and for how long can he stay put in this investment before he decides to withdraw. Very interesting question, and again on the lines, of SWP that we've been discussing. So timing again is very important, Shweta. Now, since he's already retired, a very typical case, I think you mentioned it also in your answer. He has retired now, and he's just waiting to withdraw money from this particular corpus. So practically, there is no time for his corpus to grow. How do you handle it?
Absolutely. And one thing that, while you were giving out the case, he said that he has 10 lakhs to invest, but he's looking at 10,000 of withdrawal every month, which means for a full year, he's looking at 1,20,000 of withdrawal. That's a 12% withdrawal rate. Not advisable at all, because your portfolio, given that you're retired, you have to keep the risk in mind as well. Your portfolio is growing at 10%, but you're withdrawing 12% of that portfolio, right? You'll not be able to sustain it for a longer time period. So first thing that you need to do is either you will need to take up your corpus from 10 lakhs to 30 lakhs. If that cannot be done, you'll have to reduce your monthly withdrawal that you want. One thing, either of the two will have to be done. Second, for the time being, I'm going with, you'll need 1,20,000 per year, which means out of this 10 lakhs, okay, the money that you need for the next 3 years, ideally 3.5 lakhs has to be in arbitrage funds for you, from where you will do your systematic withdrawal. Two arbitrage funds that I recommend, Kotak Equity Arbitrage and SBI Arbitrage Fund. Invest in these and you can start your withdrawals from next month onwards over here. The rest 6.5 lakhs can go in equity funds. There, I suggest you go in for, let's say an ICICI approved focus equity fund, or DSP equity opportunities fund, and one HDFC small cap fund. Last thing that you will have to do is, when you are nearing the third year end, again, you'll have to follow that cycle of roughly 30% getting into arbitrage and the rest 70 being in equity funds. So you'll have to rebalance this every 3 years for your portfolio, Srinivas.
We don't have him on the phone line, so I'm really not sure if he had anything more to ask. Now, so ideally, it's very important for people to get practical about having SWP, because you're talking about your life after retirement, and if there is no other regular source of income, you're dependent on investment portfolio, you really need to create that kind of a corpus. As early as possible, you should be doing that planning, or at least beginning of that planning. But what is that time when you, for example, if someone has really, been smart enough to invest at a very early age for a goal like retirement, you can go really aggressive initially in equities. What will be that time and that stage when you start diversifying that particular amount that you have collected in other asset classes which are safer, and from where you will have your SWP?
So, see, if you have 20 years, or I would say even if you have 10 years ahead of you for retirement, you can go as high as, 70 to 80% equity in your portfolio, and the rest of it being in debt. But as you come closer, which means, you have, let's say, 3 years for your retirement, then if you are maintaining, let's say, 20% in debt, you'll have to take it up to 35% in debt. Because your accumulation phase is getting over. You're nearing your, now the phase where this money is going to be consumed for you. So that's where I'll say 3 years to retirement, relook at your asset allocation. If you will have to look at 30 to 35% being in debt. Furthermore, as you start your withdrawals, which is, next year is your retirement, relook if you will need to have, instead of 30%, let's say a 40% debt on your portfolio. So, this would be certain suggestions or broader guidelines for an asset mix.
All right. When we are talking about the growth phase of your portfolio post-retirement, what is the amount of risk that you can take? Again, that needs to be a debt-oriented portfolio, or you can have some amount in some of the hybrid funds, or other asset classes can be a part of it. Is that advisable, or again that's case specific? If you have that kind of a risk appetite, you might as well do it.
So I would say, see, you definitely can have equity, because that's your main growth-oriented asset class, right? So you can have some portion of your money in equity even in the retirement phase. And unlike perception, where people think that equity is very risky, if you give it enough time and you spread it out well, then your risk can be managed efficiently. What I mean by that is, like if you have 5 years, this retirement money, there's 30% or 40% or 50% of your portfolio, which you're not going to need for the next 5 years, because your systematic withdrawals are happening from debt or from the other portion of your portfolio, then that money can be in equity. Now, within equity as well, don't go in for stocks, go in for mutual funds, because you buying one mutual fund is equivalent to you getting underlying 40, 50 stocks. Like that, if you're building a portfolio of, let's say, 10 mutual funds, you've spread out your stock level risk. That 10 mutual funds again should be spread out across asset management companies, across different fund managers, and don't go overboard, mid and small. So have a good amount of allocation to all, large, mid, small, in your portfolio. If you bring in these diversification principles in your portfolio, then you're going to manage risk efficiently, and the longer you give to equity, your volatility reduces. So it'll help. Even if you're in retirement, you definitely can have a portion in equity.
All right, that was a very in-depth analysis and discussion on SWP. Thank you so much on that note, Shweta, for being a part of this show and talking about these concepts and also answering our viewer queries for us today. And just in case you want to ask any question related to SWP, want a strategy from our expert, or even want to get your financial portfolio checked by our experts on the show, do send across your queries on our WhatsApp number and email ID. Time to sign off on the show. Thank you so much for watching. Goodbye.
If you like this video, then like, share and subscribe to ET Now.